Bruce, thank you for sending across questions. It's very important to know what can you contribute for your retirement, and then it's very important to save for your retirement as well. Now, the fact that you are being taxed on a higher tax rate just because of the exclusion, it may not be entirely true, because you are making use of exclusion, which is eliminating taxes on all of your income which you earned here. And I believe the retirement income is in excess to the exclusion or the salary income which you have. I know it will be taxed a higher tax rate because you're an expat living overseas and making use of the exclusion, which is about $100,000. So you're already bumped into a higher tax rate. However, you still have the standard deduction, which has a potential to reduce your taxable retirement income, that will help to reduce your taxes. So I don't think you are being taxed at a higher tax rate. Probably it's averaging it out. The idea of having a retirement fund is to save for your retirement. And if you are working with a US company, this is possibly the best way to save for your retirement under 401k or a 403b, which allows you to contribute up to $18,000, which is substantial savings for retirement. The whole idea behind these retirement funds is you save money or you save taxes while you're working, because you're likely to pay higher taxes when you're working. But when you retire, once you turn 59 and a half years, and then that's when you start taking the money out. The idea is you may not have any income or a lot of income, so you can use or you can reduce your taxable rate, and when you take the retirement out, it will be taxed at a lower rate. But you are possibly in a different situation wherein you are being taxed a higher rate because you're an expat. Depending on your age, if you are already 59 and a half, then you don't have an option to take the money out and pay taxes on it. With exclusion, with standard deduction, I would still think it better to save for your retirement. And for 401ks, you can contribute up to, as long as you're employed, you can contribute, but you have to take the money out once you're 59 and a half. So that's where the taxability start. And then if you are an expat and if you're already 59 and a half, you may have to take the money out and pay taxes. To answer your question on what is best, 401k or 403b, or IRA, both have its own self-advantages. 401k is only through a US employer, which means you can contribute more, which is $18,000 a year, which is substantial savings for your retirement fund. However, you have to take the money out starting once you're 59 and a half. But for IRAs, you can contribute until you're 65, and you can defer your distributions or withdrawals until you're 65 as well. So that gives you about 7 extra years where you can still contribute but not take the money out, especially if you're an expat and if you think you will get taxed on a higher rate. Can you contribute to a Roth IRA? It completely depends on your income level. Based on what you've said, if you're fully excluded, you may not be able to contribute to a Roth IRA, because to contribute to a Roth IRA, you should have a net positive earned income. If everything is excluded, your AGI, which is adjusted gross income, is already at zero, so you'll not be able to contribute to a Roth IRA. So to contribute to a Roth IRA, it needs a proper analysis of what is your income. We can make some adjustments and see if we can contribute as well, but that a proper analysis of your tax situation. That's including your filing status, your total income earned during the year, how much is earned income, how much is unearned income. Depending on that, we can decide whether or not you can contribute to a Roth IRA. And very similarly to a traditional IRA as well. But for traditional IRA, the catch is it will be taxed. Again, your contributions and the growth will be taxed in a future year when you start taking the money out, if you take any deductions. For traditional IRA also, you should have positive earned income to contribute. It's different. So these are pre-tax amounts. So you can still contribute even if you're fully excluded and save for your retirement. So again, there's no definite answer, yes or no, to say whether or not you're being taxed at a higher tax rate just because you're fully excluded. And also, there's no one answer to say whether 403b or 401k is better or an IRA is better. It requires analysis and mostly looking at your prior tax return. And if you think the facts are similar to what it were last year, then you can just go with the last year's facts and then see whether or not you qualify for it. Based on my experience, I would still say the 401k or 403b will be a good option if you're planning to save for your retirement. But if you need more assistance or if you want to know how that works, we're happy to have a conversation. I'm happy to chat, or we can run a very quick calculation for you.